Welcome everyone to today's webinar, The Effects of COVID-19 on Private Capital. My name is Keith Crouch. I'm on the product team here at Burgiss with a focus on the Burgiss managed datasets. Today I have the pleasure of moderating this webinar and facilitating the Q&A session at the end. Now joining all of us today are both Luis O'Shea and Tim Jenkinson. Now for those of you who don't know Luis, let me provide a quick background. Luis is head of the applied research team here at Burgiss, and he brings over 15 years of experience in quantitative research and modeling in finance. Now, Luis started his career at McKinsey in Madrid, and before joining Burgiss, he was actually a director at BlackRock, a director at Axioma, and had headed the US research group at RiskMetrics. Luis holds a PhD in mathematics from Cornell University, and thank you for joining us today, Luis. And for those of you who don't know Tim, let me provide his quick background. Now, Tim is a professor of finance at the Said Business School at the University of Oxford. He is considered one of the leading authorities on private equity, IPOs, and institutional asset management. Tim also serves as director of the Oxford Private Equity Institute and is actually one of the founders of the Private Equity Research Consortium. He is a professorial fellow at Keble College, University of Oxford, and a research associate at the European Corporate Governance Institute. And so thank you for joining us today, Tim, apologies. Today we are going to be discussing a very interesting quarter, the COVID-19 quarter, or perhaps more accurately, the first quarter of the COVID-19 era. We are going to spend the next hour discussing Q1 returns. We're going to be exploring some of the cash flow dynamics that played out during the last few months. We're going to be discussing the potential longer-term effects of COVID-19 on private capital, but we're also happy to answer any questions that you happen to ask. We hope to hear a lot of questions from the audience today, but first we are actually going to hear some prepared thoughts from both Tim and Luis. So with all that said, let me hand it over to Tim.
Thanks very much, Keith. What I'm going to do is to give you a sort of overview of what's going on in the first quarter of this year. And what I'm going to do is just show my screen for you, which I hope should work.
Yep, we can see it.
Good. So we called this the Corona quarter. There's clearly a question about how many other quarters there's going to be. But what I was going to do was to really take advantage of the fact that the latest Burgiss numbers have just been released, and to see what they really tell us about the first quarter of 2020. What I'm going to do is split this out into first looking at the quarterly returns across all the private assets. Then I'm going to focus in a little bit on the buyout and venture capital side and see what it shows in terms of the vintage year returns by fund, looking at both IRRs and investment multiples. Then I'm going to look at the interesting question about PMEs, public market equivalent returns. In other words, how did the returns evolve relative to the stock market? And this gives us a sort of indirect way of looking at how much mark to market there was, or maybe also how much smoothing is going on in private assets. And then I'll have a little peek, since I'm sitting in Europe at the moment. I'm always interested to see what's going on the US versus Europe, whether there's any differences in those sorts of trends, both on IRRs, multiples, and PMEs. The second thing I'll look at then is which sectors have been hit. And to do that, what we'll do is have a look inside the Burgiss holdings data, where we can actually look at what sector the underlying investments are in. And then finish off by looking at cash flows and distributions and see the extent to which those have changed over the last quarter, and if there's any interesting features of that. And I think there are a couple that are worth looking at, and looking back a little bit to how it compares to the global financial crisis. So fair amount to get through, but I think we can skip through this quite quickly. In terms of the overall returns, this slide shows the quarterly returns across all the different asset classes as they're designated in the Burgiss system. So, you know, if you want to be a little bit of if you want to have a retrospective and be a bit nostalgic, you can look back to Q4 2019 and see that pretty much across the board there were pretty healthy returns in that quarter. Clearly, Q1 2020 is very different. Red ink everywhere, sort of metaphorically. Overall private capital down by close to 9%. But within the asset classes, I think there's some interesting issues. If you look there within equity, buyouts down about 10%, whereas VC only 2.8%. And in the debt side, an interesting thing is the overall fall of about 10%, but senior falling more than mezzanine, which is, I think, an interesting feature of the return so far. Clearly, this is early days, and we haven't yet been through this particular cycle, but I think that's interesting. On the real asset side, perhaps there's no major surprise that natural resources, which is a majority of that is oil and gas, has not had a good quarter. Clearly, they've had both the corona crisis and they've had an oil price war as well. So, but some pretty hefty numbers in terms of the negatives there. So that's looking just on a quarterly basis, on a pooled basis across the whole of the funds that are in the Burgiss universe. If we start looking at it through a slightly different lens and look at it by vintage year, what I've done here is chart the IRRs for buyout funds as they were at the end of 2019. So that's the blue line here, and then how they've changed over one quarter. And clearly, I've stopped at 2017, but arguably that's not. I should have stopped a bit earlier because those are clearly very immature funds still. But it gives an interesting indication as to what effect it's going to have on IRRs. It sort of kicks in around the 2011 vintage year, I think, for global buyouts. And my interpretation of that is for many of those vintages, it's a couple of percentage points on the IRR, it looks like, with some potentially bigger effects on the more recent vintage years. But I suppose that's as might be expected, but it's an interesting to sort of quantify the overall effect. And these are medians by vintage year across all buyout funds, both European and US funds. If we look at the money multiples, the TVPIs, you get and again the same analysis. You see that there's a decent fall, up to about a 0.1 fall in the money multiple across this across the depending on the vintage year, with some vintage years seemingly rather more affected than others by this. So we've got, as would be expected, as those net asset values get written down, we're starting to see that fairly immediately in these measures. Now, for me, perhaps most interesting thing is to have a look at the PMEs, because there I wasn't at all sure which way this would go. I had a hunch that it might be actually that the PMEs would rise for these funds, and indeed that is true. So in other words, we see again the blue line is the median buyout PME in Q4, and the median in end of Q1 has actually risen, and clearly that's because markets have fallen more than have the valuations in the buyout funds NAVs. So that's interesting. Now, whether there will be that is a delayed effect, that somehow the effect there is that the GPs are sort of looking through the current or the situation as of the end of March, and clearly markets recovered quite a lot after the end of March, and so we might see that this is a sort of smoothing effect, that the increase in the PMEs goes down a bit as if markets stay reasonably buoyant, then maybe the public market returns will sort of come back a bit relative to the private equity returns. It will have been a smoothing, but that's I think something for maybe the next one of these is to see what's the evolution of those PMEs. But so far, the write-downs in the private equity buyout portfolios have been more limited than public markets. So that's the situation on the buyout side. What about venture capital? And I think in general, the effects on VC seem to have been a little bit less. The IRRs, the effect on IRRs goes back a bit further. So you can even see it back to the 2008 vintage year funds. You're seeing small effects. And again, a sort of a percentage point, or perhaps sometimes a bit more, sometimes up to 2 percentage points effects on the IRRs by vintage year. And money multiples, not a huge effect there, but still obviously write-downs, modest write-downs, I would say, in the TVPIs. When we move to PMEs, a same sort of effect, clearly, because markets, this is relative to the S&P 500, and so the S&P 500 by the end of March had fallen a lot, and these venture capital valuations hadn't fallen that much. So there's a pretty large increase in PMEs here. An increase of like 0.15 in a PME is a very sizable increase. And I think I would predict, although I don't want to be look too far into the crystal ball, that this might start coming back. The PMEs might start coming back in the next quarter if markets stay the same. But on the other hand, you know, technology, some of those venture capital investments may actually have done pretty well through this period. There's clearly some that we can think of that will have done. So that's really looking at those three metrics of performance. If you want to see what's going on whether there's any issues there on a US versus a Europe basis, pretty similar results, I would say. Here we're measuring European buyout funds actually relative to the S&P 500, which is S&P 500 has been a hard taskmaster, especially in dollar terms. So that's perhaps why the European PMEs don't look perhaps as high as you might expect relative to the money multiples and IRRs. But I don't think any noticeable difference really between the Europe and the US. If anything, when I eyeball that, I see maybe a little bit more of a write down in Europe relative to the US, but it's fairly marginal, I would say. So that's, if you like, what's going on the fund return side. Moving now to the sectoral returns, I think there are some very interesting things going on here. So this is breaking down the returns by quarter according to the sector of industry that the portfolio company is in. And there are clearly some, you know, I think the patterns are very intuitive here, which is, I think, very reassuring. So utilities, rather small effect, consumer staples, virtually no effect. And then we see you know, we see consumer discretionary going down hugely, energy minus 30%, and also we see some other sectors doing reasonably well, like information technology. And then even within the something like the real estate side, you can start seeing the differences between the different types of real estate, with, for example, things like industrial warehouse logistics actually not doing too badly at all, whereas things like retail and office real estate has had a pretty bad quarter, from the end of 2019. So that's a little snapshot of the sectoral returns. And then just to finish off with the sort of cash flows of what's been going on here, I think there's some very interesting patterns. This chart shows the contributions, the capital paid in to private equity funds by the LPs in blue, and the distributions in green, and the yellow dotted, the yellow line is showing the net cash flows. And so, you know, as is fairly well known now, you know, for the last 6 or 7 years, the private equity has been cash generative in terms of, you know, it's been distributing more than the contributions. If you look in terms of the last quarter, that's actually been rather interesting insofar as we've seen some pretty decent distributions still happening, as I think a lot of the deals that were in the offing were you know, carried through and exits were achieved. But you do see this quite noticeable uptick in capital contributions in March. Less so in February, clearly, but March is a fairly large capital contribution. When you annualize that up, it gets to about, if at annualized rate, that would be about 360 billion, which is way higher than we would normally see on the equity side. And interestingly, if you break it down into debt as well, you see a similar effect coming through there. Clearly, debt funds, as they've been growing in recent years, the cash flow has been more neutral, in fact, often negative. But you see this big downtick in terms of the net cash flow in March, which is very noticeable. I think Luis is going to talk a little bit more about this and wind the clock forward a little bit further. But that's a sort of first glance that something interesting was happening in terms of the capital calls in March. And if we look at real assets, it's a sort of similar story. Again, more neutral the last few years in terms of the cash flows, but last quarter and certainly March, the real height of where things were starting to implode, pretty sizable capital contributions in that month. So if you look at that in a slightly broader perspective, is this different from 2008? So we've extended this chart all the way back there, and clearly at the time before 2008, we were in a period where cash flows had generally been negative in terms of there'd been more capital contributions than distributions, and that carried on for a fair while. Here it's split out by buyout and VC. You see, there were some fairly big capital calls in 2008, and then they very much sort of disappeared for a while in 2009 as the crisis really struck and things shut down. And it will be very interesting to see whether similar pattern actually happens this time, because so far Q1 is a pretty big capital call quarter. So it will be interesting whether that actually continues, and if it's got anything to do with subscription lines or something like that, which we can maybe explore a little bit further in a minute. So just some final thoughts overall. So there's been about a 9% fall in private assets over the quarter. Interesting that there's so far relatively little impact on VC, but a sort of double whammy for natural resources, in particular the energy funds. So I think you can see the IRRs and TBPIs being hit for vintages back to about 2010, but PMEs have risen. So that will be the interesting thing, I think, to look at in the future, whether those were smoothed or whether they were just delayed. And so we'll see that in a sense. Are those current asset values, the sort of net present value of future cash flows, is an interesting issue. And I know that back in the 2008 vintage year, it took a long while, for example, for venture capital to actually catch up with their valuations, to catch up with the reality that cash flows were going to be different in the future, as some research which I've been involved with has actually shown. I think the sectoral returns are pretty much in line with intuition, and on the cash flows, I think there's a very interesting uptake in contributions in. Actually, I should have put March there. I think I'm anticipating April. So, but what I mean there is March. So at this point, I think I'll stop and hand back to Keith.
Sounds good. Thank you very much, Tim. That was insightful, and we are definitely going to be getting some questions on those slides. And I would actually say we've started to get some questions already, but before we do any questions, I would like to hand it right over to Luis, who's going to walk through his prepared comments.
Thank you, Keith, and thank you, Tim. Actually, let me just get my video going. Okay. So, Keith, everything looks good.
Yep.
So yeah, so thank you, Tim, for some fascinating perspectives on some recent private capital data. What I wanted to do in the next few slides was essentially two things. So on the one hand, I wanted to essentially look at similar data to the data that Tim was looking at, particularly returns data, and just slice it and dice it in a slightly different way. And then second, I want to look at some data that is the absolutely most up-to-date data that we can see, which is pre-release data, not currently in the BMU, but will give us an idea of sort of the latest things that are happening in this evolving crisis. So the two topics I'm going to look at are, on the one hand, I'm going to look at returns, but I'm going to look at the dispersion of returns. And then the second thing is I'm going to look at, as Tim mentioned, I'm going to do a deeper dive into the current state of cash flows in private capital. Okay, so starting with returns. So normally, of course, when we look at the performance of private capital, it would be normal to use more long-term measures such as IRRs and TVPIs, but clearly to look at the effect of rapidly changing effects in the market, we want something more short-term. I'm going to look at quarterly returns here. And as a measure of dispersion, I'm going to look at the intra-quartile range. So all I'm going to do is I'm going to look at the returns each quarter and look at the difference between the 75th and the 25th percentile return. And what I've done here is I've grouped the data by the courses classification in our PCCS, in other words, the top tier classification. And these are the three biggest categories there, namely equity, debt, and real assets. So maybe I'll start by looking at the debt panel, which is the one in the middle, since I think the picture there is particularly clear. So as you can see, this measure of dispersion, which, by the way, in terms of interpretation, I suppose I would say that dispersion is a measure either of uncertainty in effect the valuations of funds at the end of Q1 or at the end of each quarter, or perhaps alternatively just a measure of how much information has been incorporated into the markets in each quarter. So in any case, looking at debt, as you can see, the dispersion clearly shot up in Q1 of 2020. In fact, it roughly tripled from maybe around 4% to around 12%. Clearly a sort of a dramatic change. One other thing I'd comment actually about these dispersions is that, as I think Tim mentioned, there is a lot of seasonality in this, so that I've deseasonalized the data a little bit. In particular, Q4 is always special, so it's been sort of the dispersion is typically around 30% more, so I've deseasonalized that to make the picture a little bit clearer. In any case, comparing the spike in Q1 with history, and particularly with the GFC, you can see that back in 2008 Q4, which is the vertical, the sort of the largest spike in purple, clearly the current spike is not as large as that. But I think one thing that's interesting and goes back to the smoothing comments that Tim was making is if you look at the preceding quarter before the 2008 Q4, which again is the purple spike, to 2008 Q3, which is the bluish spike, that actually is a very similar size spike or increase in dispersion to what we're seeing right now. And also perhaps in sort of analogy, that's actually the quarter where Lehman collapsed. And you could say that perhaps to the extent that that was a trigger for what happened during the GFC, Q1 has contained the trigger for at least the current phase of the COVID-19 crisis. Now, of course, had the markets post Q1 not recovered, I think it'd be reasonable to see an increase in the next quarter in dispersion, much like we saw in the GFC. But given that they have recovered, my guess is that probably they're sort of going to stabilize, and we won't see something like that. In any case, moving on to real assets, we see a fairly similar pattern to what we see in debt, in particular, a similar sized increase in dispersion, return dispersions in Q1. And then perhaps slightly interestingly, looking at equity funds, while I'd say there is a small increase in the dispersion in Q1, it's remarkably small, and I'd say that it's easy to miss actually in comparison to previous quarters. So next, I just want to look at the same data and slice it and dice it a little bit more finely. Here I'm using the second tier of our asset classification. So again, I'll start with the middle row, which is the largest subcategories of debt funds. So in this case, senior, mezzanine, and distressed. So here, a pattern we see very clearly. We see it here in returns. We also see it in cash flows and in other areas of this data, is that the outlier is distressed debt. So in this case, the dispersion shot up to around 20%, a big outlier compared to recent quarters. But perhaps I'd also point out, also as Tim mentioned, the remarkable increase in the dispersion in senior funds, perhaps all the more so given how undispersed the returns were, not surprisingly given the asset class in previous quarters. Then maybe moving to the bottom row, which are the sub-asset classes of real assets. The outlier here is, of course, natural resources, which is what you'd expect given the returns that Tim mentioned. And as Tim mentioned, while this may be partially a pandemic effect, it's undoubtedly, obviously, a function of what's happened with energy prices. And although oil futures haven't yet gone negative at the end of Q1, they had certainly declined a great deal. On the other hand, to the left of that is the real estate panel. And I think what's interesting there is actually how, while there is an increase, of course, in the dispersion in real estate returns, actually how little that increase is. And all the more so, at least in my opinion, given the fact that we know that within real estate, there's a significant bifurcation by property types. So obviously, property types such as retail or hotels are behaving very differently from industrial. So I would have expected that would result, even looking at fund level data, that would have resulted in a sort of significant uptick in dispersion. So it's kind of interesting that it didn't. And then finally, looking at the top row, which are the major sub-asset classes of equity funds, again, we do see some increase now in the dispersion in expansion capital and buyout, and perhaps mirroring something that Tim said, venture capital is remarkably stable. In fact, there's no apparent increase in the dispersion at all there, which I think is a little bit surprising too. Here in the next slide, what I want to do is look at the same kind of data, but just essentially combine the return perspective with the dispersion perspective by looking at the probability or the fraction of funds that suffer a sort of large negative return. So I'm going to somewhat arbitrarily define a catastrophic return as a return that's worse than negative 30%. And here we see a couple of interesting points. One is, again, our friend distressed debt that had an astonishing 15% of those funds suffered a catastrophic, by this definition, return in Q1. Again, natural resources, the expected outliers. Here, I think we see a sort of more clearly, because we're blending in the sort of the actual return, a spike in expansion capital and buyout with about 5% probability of catastrophic returns. And once again, venture capital, a remarkably sort of muted effect. And then finally, before I leave returns, I wanted to look at the actual, in a sense, the raw data by just looking at the sort of the whole collection of returns. So I'm going to focus on distressed debt, and I'm going to look at the returns in the last 4 quarters ending in Q1 of 2020. And here, what I'm doing is I'm plotting the probability density function, or essentially it's the smooth histogram of the actual returns in each quarter, quarterly returns in each quarter. So I would make maybe 2 points. So first, if you look at the bottom left-hand corner, so that's the graph that's in purple, and you compare it with the top two, so the purple is Q4 2019, and you compare it with the top row, which is the previous 2 quarters, you can see that the purple histogram is somewhat more spread out than the other two. And this is a reflection of the seasonality that I mentioned, that you tend to see, perhaps as one would expect, a greater amount of dispersion in Q4. And then moving to the Q1 2020 histogram, which is the red plot on the bottom right, here you see clearly that it is spread out by a significant degree. Not only that, it particularly has spread out on the sort of the left tail side. And in fact, I would say that the distribution of returns is, let's say, suggestive of it being multimodal or bimodal, in the sense that there seems to be a cluster of returns that are around the median, which, by the way, is the vertical dashed line. And then for Q1, which is the red one again, there does seem to be perhaps a second category of distressed debt fund that suffered, as you could call, catastrophic returns, with a sort of a cluster centered perhaps around negative 30%. Okay, so next I want to move on from returns to cash flows. And just before I talk about these, I want to just make an observation about the difference between this kind of data and the returns data. So first of all, returns data, performance data, requires valuations, which means that in effect we needed to look at the Q1 valuations, and there's nothing more up to date, at least in private capital, that we could look at. Furthermore, valuations by their nature suffer from a timeliness problem, and also, as Tim mentioned, a sort of a lagging problem due to their fundamentally subjective nature. So anything to do with performance, there's a limit on how timely the data you can display is, as well as this sort of lurking lagging problem that we know is behind there. In contrast, cash flows can be observed more or less in real time. So I thought that would be an interesting thing to look at here. Note that by looking at data that is absolutely the latest data, we're stepping outside of the latest update to the BMU. So this slide and the next slide are pre-release data. So please bear that in mind. So what I've done here, in any case, is I've looked at cash flows. I've grouped it weekly, which is another advantage of cash flow, that we can sort of group it more finely than the return data. And then what I've plotted along the vertical axis is just the cash flows as a fraction of the total capitalization of active funds at that point. Bear in mind that funds stay technically active for a very long time, which means the denominator is probably somewhat larger than you might think it is. But what we really care about is really the comparison with previous years, and also a temporal comparison. So what I've done here is I've plotted in red is the 2020 data, and then in black, I've taken the average of the previous 5 years of data, and then I've superimposed a gray ribbon that shows the standard deviation of those 5 years. So looking at this data, we see something that Tim commented, which is the remarkable spike in March and April. In fact, that spike more or less begins at the middle of March. I realize that the axis, the horizontal axis, is probably a little bit hard to read, but the spike essentially begins in the middle of March and then continues up until the last 2 weeks of April. The spike probably begins a week earlier for debt funds than it does for equity funds. And for debt funds, the spike is very remarkable. It's probably of the order of a tripling in that period, or at its peak at any rate, of the contributions. In the case of equity funds, the increase during that spike is maybe something like about a 33% increase over historical. This is when I say an increase, it's over historical norms, which is the black line in this graph. Then once we get out of that spike, then we see a decline to below historical norms, which I suppose is what probably one would expect given what we've seen in previous crises, such as the GFC and in the dot-com bust. So in particular, for example, for equity funds, if you sort of smooth out that graph, roughly the contributions post-spike are about 50% of what they were in the recent past. In the case of debt funds, it's even lower than that. In the case of real assets, I think that the picture is a little bit less clear. Turning to distributions, which is the bottom row of panels on this graph, we see, first of all, of course, there's no analogous spike in distributions in March and April. And there's also, but having said that, there is also a very steep decline in distributions. In fact, the decline in distributions, once you get outside of the peak, is probably greater than the decline in contributions. So what's interesting about this, of course, is that for a private capital portfolio that has been set up in such a way that distributions approximately fund contributions, then these kind of moves are very concerning. Of course, the spike in contributions has no analog, as I said, in distributions, so that was probably uncomfortable. But even once you get outside the spike, the shift in contributions or the decline in contributions is not quite as great as the decline in distributions. And then finally, of course, for some asset classes, such as real assets, which is mostly real estate, the decline in distributions is even more dramatic than the decline in contributions. So finally, I wanted to look at a topic that Tim alluded to, which is what is triggering that remarkable spike in contributions that we saw between the middle of March and the middle of April. So the two candidates, of course, are on the one hand, contributions that are funding actual investments. And the second one would be funds that are repaying subscription lines of credit. So to try to tease out to what degree the latter might be happening, what I did here is I looked at a subset of our universe of funds that are funds that are using, that have a significant balance on their sublines. And then I contrasted that with just the broad universe. So the top panel is simply all funds, and the bottom panel is the high subline utilization funds. Then again, it's just, here I'm just displaying contributions, and I've grouped the data monthly. So what you can see is, looking at March, the peak in contributions across all funds was in March. But then once you move to April, looking at all funds, there was a gentle decline in the amount of contributions. In contrast, looking at high subline utilization funds, the contributions went up in April. And then perhaps even more dramatically, if you look at what happens in May, at that point, across all funds, the contributions have declined to significantly below historical norms, so roughly 50% of historical norms. But looking at the bottom panel, in May, contributions, while they did decline, have declined only to about historical norms, or perhaps even slightly above it. So I think the contrast between these two kinds of funds, all funds and high subline utilization funds, suggests very strongly that, in fact, a lot of the capital calls are really being driven by repayment of sublines. So with that, I think I will turn it back to Keith so he can start the Q&A session.
Thank you, Luis. So to everyone in the audience, if you haven't done so already, please feel free to ask any questions that you have right in the GoToWebinar form. There'll be a question panel in there, and we are going to move into the Q&A session of today's webinar. Now, I guess as a first question to start us off, as the audience is asking their questions, in your research, and this is to both of you, perhaps Tim, you can answer this first if you'd like. In your research, did you find anything that was particularly unexpected in the first quarter returns, and perhaps a little bit more broadly in anything that you looked at in preparation for today's webinar?
Yeah, I think I didn't really know what was going to happen to the PMEs. That was the thing I was perhaps most intrigued by, because, you know, there's all this, all the talk in the industry about how you know, mark-to-market accounting has really spread in since since sort of 2008-9, and whether that would really mean that they were much more volatile with stock markets. And I think this is maybe the biggest shock to that system since then. So it's if you like the first indication that we've got as to the extent to which maybe valuation methodology has changed. And so I was pretty surprised that venture capital returns were kept up so high, that there was relatively little markdown on the VC funds. I think that was surprising to me. And then the second thing that I found really intriguing was this March effect on the contributions, which Luis has been sort of peeling back some more layers of the onion to try to find out what that is. But what's the incentive going on there? Why are if it's subscription lines being repaid, it's interesting to think, well, why is that happening? And is it to replenish it so that it's available for other deals? Is the bang for the buck of subscription lines a bit less when in a negative return scenario? And so I think that that's, if you like, I don't think we have the answer to that yet, but I think that was certainly an interesting thing that I hadn't expected to see.
Yeah, and then maybe I wanted to echo Tim's comment about venture capital. I think it was surprising just how little in the data that I looked at you saw an effect on venture capital. As I said, in terms of the dispersion and returns, there was no uptick at all in venture capital. And that's particularly surprising because while you could say that perhaps there's different kinds of investments VC firms are making, and some of them, as Tim mentioned, could be doing quite well, if that was what is happening, you'd actually would expect an increase in dispersion. So it sort of seems that it's hard to believe that that's exactly what we're seeing in the data. It seems more plausible that it's just a sort of a lagging effect, but again, we'll see in Q2.
Okay, well, thank you both. I mean, one of the questions from the audience kind of speaks to maybe some of what we touched upon a little bit here. So this is directed specifically to Tim, and it's an audience member hoping if you can speak to the observation of the senior debt returns being lower than mezzanine and essentially worse than many of the other asset classes. I know me personally, my naive assumption is that senior debt funds would have seen less losses than some of these other asset classes, but they were actually particularly negative returns. So any thoughts on what's going on here?
Yeah, I may disappoint on this one. This was striking to me, especially when you look at the returns where senior and distressed have got pretty similar sort of reductions or quarterly reductions in their returns, and pretty sizable, right? Over 10% reductions. And then you've got the mezzanine there at 7%. And I don't know whether there's something to do, whether this is somehow related to the the equity component of mezzanine returns, because often these would have an element of equity in there as well, and maybe there's a bit of a lagging effect there. Some of the equity instruments, the warrants or the like, which might be also in there, and mezzanine have yet to be marked down. That's my best shot. Apart from that, it doesn't. I found it quite surprising as well, and it didn't. I couldn't come up with any other clever answer other than maybe it's because it's got a bit of equity lag in the valuation there.
Interesting. I don't know, Luis, anything to add on that point?
I mean, the only 2 cents, and it's speculation as whether there could be some kind of leverage effect going on, but beyond that, I think there's not much I can say.
Okay.
Well, maybe I'd say one more thing, which is that there is the kind of analogous picture where if you look at aside from the returns, if you look at the dispersion of returns, there was an enormous difference between mezzanine and senior. So mezzanine debt returns were not particularly, the dispersion didn't increase a great deal, but senior was not as extreme as distressed, but it was a huge increase in dispersion.
I think that dispersion slide might actually be a good one to go to because we have a question or two on that area. So let me pull up the dispersion of returns. So A question that we have is, so in the venture capital world, the dispersion of returns is, well, it's actually flat to
Yes.
the previous quarter. And so we have a question of, so how much of what's going on here do we have a sense for is based upon the actual valuation approach? So they're simply just looking at the last round of financing, or are these venture capital investments, are they being more marked to the market, and these are more real returns, if you would? And that's obviously open to both of you.
So I guess two comments. One is, at least in our database, we distinguish, of course, between reported returns. So this is based on reported returns, but that doesn't really settle the question of whether, to what degree there's been kind of mark to market truly going on. As I was saying before, given the different kinds of exposures that VC firms have, I personally find it hard to believe that there could be so little increase in the dispersion of returns. So I would lean towards it's a mark-to-market effect, but hard to
Yeah,
know.
I think I would as well. I mean, I find it quite. This is a little bit similar to what happened in 2008. I alluded to some research which we did looking back at the cash flows which occurred subsequently to 2008. Because one of the good things about private equity is, funds come to an end, and so you can ultimately see whether the asset values at any one particular time are actually the net present value of the future cash flows. And we actually found that in 2008, the valuations of venture capital funds took a long time to adjust to the economic reality that their investments were going to yield less cash. Now, this is slightly hinting to me that the same may be happening here. And it was much less so with buyout funds, where the change was relatively quick, and it was a pretty good predictor of the future net present value of cash flows. I feel this is a bit, maybe there's a bit more adjustment to be had to the valuations.
Okay. Well, maybe one more question in the spirit of returns. We've touched upon it a few times, that lagged reporting is an interesting and annoying characteristic of private capital. So obviously, we only know the valuations several months after the end of the quarter. Now, what was interesting about this quarter is from the February peak, equity markets, we know, collapsed through the end of March, and so they were down. At least the U.S. equity markets were down something like 30%. But they had actually started staging a little bit of a rebound, but that rebound continued over the next 45 days. And so, I suppose a question to both of you is do we think managers valued their investments true to how the world looked at the end of March, which was a very dark period, or did they perhaps peek a little bit into the future, or what was the present for them as they considered their valuations?
I guess what I would say to that is, so I think the point the question is making is that private capital returns, I think Tim's kind of summary number was down 9%. Clearly, towards the end of March, it could have been much worse than that, one would think. So what's the sort of the discrepancy between those two? And actually, particularly if you focus on equity funds, the discrepancy is still there. So the two explanations that you could say is either funds are, in a sense, peeking into the future beyond Q1, and we know, or we suspect that there's an element of that, but it's probably a small, statistically sort of a small effect. But what we know is a sort of a big effect is the sort of, what I call not the timeliness, but the lagging effect. So simply that it takes a long time because of the subjective nature of valuations for the current state of the market to work its way into the actual valuation. So at least if I was going to say here, I would say that the observed returns are, similar to what we saw during the GFC. It would take normally several quarters to fully bake itself into the valuations in private capital. Now, of course, because the market has recovered, that is going to cloud what's going to happen next. But at least in principle, I think that that's what's going on.
I'm prepared to bet a very small amount of money in a soft currency like sterling that the Q2 number will be between the Q4 2019 and the Q1 2020. In other words, we'll see another PME number, which will be in between the two, and that would speak to smoothing, I think, a little bit of a peek ahead. I could be wrong, but I would, as I say, I would bet a little bit on that on the PME chart, that it'll come back. So in other words, the PMEs will come down because they, in a way, I think some of the private equity funds, the buyout funds, have sort of banked some of April's recovery. That's my suspicion, but we'll see. Valuation is a very hard thing to do, I have to say. You know, it's very hard when you're valuing something which you're not actually selling, and then trying to ignore the future. I think it's sort of natural in a way to peek a little bit into the future if you're doing your valuations in April or May, and to sort of ignore the fact that the markets come back. So I think that it's that's my prediction, a line in between that red and blue line.
Okay, I like it. So let's maybe change gears a little bit. I'm going to go to one of the slides from the presentation that Louise put together. So, and maybe we should elaborate on this a little bit more because it's kind of interesting. So the top and the bottom graph here are actually the y-axis. So we can see that the high SLOC usage funds peaked at, that's over 3% in April, while all funds was actually only about 1% of capital, and that peak was in March. So that is actually, I guess, relatively off the charts capital calls for any fund which had a subscription line of credit outstanding. So any thoughts on kind of what was going on here, and perhaps more generally, do we think that the usage of SLOC in these funds, will it have helped the funds or hurt the funds? Are there going to be any kind of implications now that we've had a little cycle of a downturn with these SLOC usage?
So I have maybe two comments to make about that. So the first is a cautious sort of statistician or economist comment. So I think you're right. I think that the difference in the absolute levels of all funds versus the bottom panel, which is high subline utilization funds, is remarkable. However, the caution, so I think it could well be indicative of something, namely that high subline funds were behaving somewhat differently. But the truth is that the caution I would give is the comment I made earlier about the denominator. So here, in order to make the red line comparable with the black line, I didn't want to plot absolute dollar terms, because the absolute dollar terms were different simply because there's a different amount of capital at work. The funds, the total capitalization was different over time. So sufficiently different that it would make a big difference. So instead, I normalized it by dividing out by just the capitalization at each point in time. The problem there is that normalization is useful for this kind of comparison, but I think clouds the absolute numbers for the reason that I mentioned earlier, which is that the total capitalization of active funds is something that is a slightly strange number because funds take a long time to completely shut down. So that, for example, you could get the larger apparent contribution rates in the bottom panel if for some reason high subline utilization funds tended to fully liquidate a little bit more rapidly than the others, even though that wouldn't be an economically meaningful difference. So the first comment is simply that I think you're right, Keith, or the question. It's suggestive that there's this sort of difference, but it's possible that it doesn't really mean anything. And then I think the second point is, what effect, I think, would this change in when capital is being called, or what the fact that this suggests that there was a spike in capital calls that was caused at least partially by repayment of sublines, what effect that'll have on things like IRRs or something. Is that right, Keith? That was part of the question?
Well, yeah, so that is a kind of part of it is obviously SLOC usage can affect IRRs. So, you know, is there any longer term effects to this kind of stressful quarter with the way how how GPs and LPs think about these facilities?
Yeah, well, I suppose there's a sort of a mathematical fact that I think is worth mentioning, which is that if you call capital later, which subscription lines of credit allow you to do, then you effectively tend to amplify IRRs. So a positive IRR tends to become a larger positive IRR. A negative IRR tends to become a more negative negative IRR. So consequently, a result would be that if you are repaying your subscription lines of credit, then any negative IRRs that will subsequently appear will tend to be diluted slightly by that effect. So I think that's a mathematical observation that's worth making.
Yeah, and I think there's, and again, I'm speculating here, but there's a sort of behavioural potential explanation here as well. You know, there's the sort of the heaven of you know, not drawing or paying for something on a subscription line, then exiting and never having to draw the capital and making a big profit. That's when subscription lines are wonderful, right? We never asked for your money and we've already delivered you a profit. But there's also the negative, right? Oh dear, we've actually invested your money. We've lost it all, and could you give it to us now? So that's, you know, that I guess is the, you know, the behavioural thing that, you know, subscription lines can go negative as well, and it might be better to just say, can we have it before we lose it? So I don't know. This is again slightly sort of speculative, but I think that Luis's point is the one I was alluding to earlier, that the case for using a subscription line is much less compelling. In fact, it's sort of not compelling at all when your returns are going down.
And I think Tim's behavioral comment, although you were making it in a joking sense, I think there's an underlying, there's a great deal of truth to it, in the sense that precisely that dynamic may well be affecting both the funds and also the banks that are offering the subscription lines of credit.
All right. Now let me take us to the slide where we break out some actually holding returns. So something that, as someone knows, particularly interesting is that obviously this is a kind of a very interesting breakdown by industry geography around the world, but kind of looking at the property type split, we can see single family returns were actually positive during the quarter, even in the face of residential returns being negative. So kind of a more general question here is what industries do we think, what sectors are best positioned for whatever new normal that we find ourselves in?
Wow, that's a tough one. And I wondered a bit about that single family numbers, because, you know, to some extent the housing market in many countries is just literally, or even sort of being shut down legally. You know, you can't transact essentially. So whether we're seeing whether we've got data there, I don't know. Obviously they're funds, so they should be marking to market, but there isn't a huge amount of transaction data there. I think the question, whenever you struggle with a question, it's good to pose a different one, which is a sort of related to yours, which is, I think that this crisis has really made me think very carefully about how we think about risk. Because I think in the past you might have said, oh well, consumer staples, you know, those are really great things to be in a recession. But now you start thinking, well, a lot of those consumer staples didn't have a digital channel at all. And so they've been pretty much shut down, you know, your pound stores or the like, which don't really have a way to to get to market. And I think that there is a very interesting issue about, you know, in terms of your portfolio, how you think about positioning it so that it will be robust against these sorts of risks. And I do think it will be those multi-channel sort of operators who within these sorts of spheres, because, you know, you can clearly, even within consumer discretionary, there's some firms that have done pretty well because they had good digital channels. And I think it is one of those things where investors and funds are going to have to think quite carefully about what it is that is actually a low beta type stock. And indeed, this isn't beta. This is a different type of risk, but a pretty catastrophic risk. And I think that that's what a lot of people will be rethinking is, you know, when they're investing in thinking of buying companies, this will be an extra risk that they're really going to have to think about.
Maybe one comment about the negative return in, let's say, office, and then the very slight positive return in single family. And admittedly, this is pretty speculative, but I suppose it might simply be a reflection of an effect from the work from home that we're seeing, and possible ongoing work from home that may become the new normal, which one might expect would result in a kind of a rotation from outside of commercial real estate towards working from home. And conceivably that might result in sort of downward pressure on commercial real estate and at least a somewhat lift on single family.
All right. Well, so maybe as a final question, because we're just about at 10 o'clock, we touched upon it a little bit, but any thoughts on what we're going to see in Q2 returns? Are we simply going to, let me bring us back to this page, are we simply going to see a positive sign in front of some of these numbers, or what are we going to see?
Well, since I'm the one who can who's prepared to shoot from the hip, I think we'll see positive signs here, but maybe not as much as you might think. So I think that there's smoothing going on here. Public markets have shot back in many countries, especially in the US, and I think we will see smoothing across the first 2 quarters of this year, and that's why I say I think the PMEs will come back. Obviously, some of those sectors, I don't think it's not looking very good at all. I mean, clearly the equity type sectors, I think will come back. Whether we're really going to see much of a jump back in some of those other sectors, I think the debt side has still got to work its way out. It's not at all clear to me what's going to happen there. And on the natural resources, well, it was a bloodbath last quarter. It probably much less so. You can't keep going down by 23%, but I haven't seen a huge reason for a big bounce back there. So I think it will be black and red, I think.
Okay. Luis, any thoughts?
So I think my only comment would be that while I'm not going to forecast in any meaningful sense, on a purely sort of like econometric terms, I'd say that the lagging that we expect occurred in the Q1 returns happens essentially just coincidentally to end up with private capital at roughly where it should be. And as a result, again, on purely econometric terms, if I were to bet, I would bet numbers around 0 in Q2. But again, that's purely econometric reasoning, not a forecast.
Okay. Well, we will be sure not to hold either of you to those predictions too closely. So that actually brings us to the close of today's webinar. So first, I want to extend a big thank you to both Tim and Luis for joining us today and providing their thoughts. This was very insightful. And of course, I would like to thank all of you for joining us today and asking such good questions. Now, there were a few questions we didn't get to during the live session. We will be sure to follow up with you individually afterwards. And then as a final note, and let me go to this screen, you can access the research of both Tim and Luis. There's links on the screen, but of course you can reach out to us at Burgiss and we can direct you to these. They have a lot of research and you should really take a look at some of it. So thank you everyone and enjoy the rest of your day.
Thank you, Keith. Thank you, Tim.